Thanks, everybody. My name is Matthew Brown. I'm a partner at Carey Olsen, one of the sponsors today, and I'm delighted to be able to introduce this session. It's going to be split into two. First 45 minutes, as you'll see, is a panel discussion about embracing the disruption from the Fintech sector. The moderator for this panel is Cobus Visahi, and apologies if I just completely butchered that. Cobus is the CEO of Africa Merchant Capital, which he founded in 2012. It's a boutique merchant bank that provides corporate finance and advisory services for mid-market businesses in sub-Saharan Africa, prior to which Cobus had a successful career as a professional rugby player, both in South Africa and here in the UK for Saracens, was it? So without further ado, over to Cobus. Thanks very much.
Thank you very much. Am I live here? Okay. I'm just quickly going to get our panel on the stage. Firstly, Mayur Patel. Mayur is based in South Africa, but he's Chief Commercial Officer of M-KOPA, one of the region's largest commercial financing platforms. He's had previous stints as COO for Cassava Fintech, as well as that was quite exciting for me to see that he's also was CEO and founded the award-winning mobile streaming company, Kweze Iflix, which was a mobile streaming app for Africa. Secondly, we've got Tim Noy. Tim is also based in South Africa, doing business in East Africa with Fin. He founded the company with, I imagine, a Zimbabwean, if his name is Tonderai, Matezwa, in 2019, and they do financing and loans in those markets. Next is Jack Sirett. Jack is a partner at Ebury. He's one of the most prominent FX providers in the market, based here in London. He regularly writes for the Wall Street Journal and the Financial Times, and he's a specialist in commercial FX hedging and risk management strategies. Next, we've got Andre Ayotte. Andre is a Canadian, based in Canada, doing business across Africa. He's focused on both VC and PE, which is quite unique in the market, doing that in the form of Modus Africa, which is primarily funded by single-family office. Thank you. And then lastly, we've got Alvaro Perezcano. Alvaro's got a very good emerging market and frontier market view, in that he's an investor through Speedinvest in both the LATAM, the MENA, and the sub-Saharan African market, so he'll give a good perspective of that. Most notably in Africa, Speedinvest is invested in Move, Fair Money, and Rivier. So I think it's a fantastic panel with a very good oversight of the fintech market in Africa. And I think I'm maybe going to start with you, Alvaro, because you've got the view. Sometimes, I've listened to my own countrymen speak about South Africa. Everybody's pessimistic, and I want to say to them, maybe you've never been to Lebanon or another frontier market and experienced that. But I think, Alvaro, the question is, to what extent have the payments and fintech industry in Africa, how has it followed in the footsteps of the global trends in fintech and payments? And maybe where is it ahead of the market?
Yeah. Look, I think Africa is an extremely interesting market when it comes to payments specifically, right? We are all aware of the fact that mobile money was an incredible innovation that really spurred ahead of a lot of other, let's say, emerging tech markets, but even ahead of a lot of other developed markets. And so in that sense, certain regions in Africa were really spearheading the payments movement. To that extent, I think in peer-to-peer transfers, in consumer-to-consumer payments, Africa has always been extremely strong. But I think that lately, a lot of that innovation in other emerging tech markets has also, let's say, caught up. And there's an opportunity to build way beyond that, not only on the payments front, but also on a variety of different kind of fintech verticals. And so with that, I think we're seeing certain regions in Africa emulating a bit what has happened in other emerging tech markets, such as Latin America or India, for example, right? We have things like card payments becoming very, very relevant in certain regions. We have the advent of point-of-sale systems. We have the advent of more specific, let's say, business-to-business payment transactions that are really following in the footsteps of certain other regions like Latin America. So I think, yeah, to kind of sum up, I think it has always been particularly strong on the peer-to-peer transfer network. That was something that was completely innovative in the region. But I think there's a big opportunity to continue to build on that innovation in the region.
Thank you. Mayur, is there some further perspective you can give on this?
Yeah, I mean, I think if you going back to your question, how's Africa sort of the trajectory of payments, how's it evolved separate from other regions? I mean, really fundamentally different stories at its core. If you think about the changes and the innovations that have happened in European and more mature markets, that's really a bank and card-based model that has evolved. If you think about China and East Asia, that is really an app-based, consumer-centric evolution. It's sort of no surprise in those markets because smartphone penetration was over 70%. So it was truly app-based. And if you look at Africa, not card-based, not app-based, but really at its core, agent-based innovation on the payment side, starting, as Alvaro mentioned, with mobile money. And I think we all know that story well. But even sort of the later stage payments changes, if you take a market like Nigeria, the fundamental disruption that has happened around that has all been agent banking-based payment changes. So 3 very, very different stories as to the kind of evolution in Africa. I mean, today, if you kind of think about where Africa has led and continues to lead, something like over 3 million agents that are across the continent, which is supporting partly on the P2P side, but now even more on the merchant and bill payment side. And if you even take a small little country like Zimbabwe, which is my home country, we're a market of about 12 million people at best. A lot of Zimbabweans have left. And we have about 50 to 75,000 agents. That's almost one agent for every 250 people. So it's just a complete radical different model that has led a lot of the kind of first wave of fintech changes in Africa.
And the trend, is there going to be a trend away from that? Because it's not efficient.
Yeah, I mean, I think, is there a trend away from it? I think we're a long way away from kind of people moving off that. I think it's kind of created the core foundation and rails for a lot of the next stage of evolution. We're sort of probably at the end of the beginning of that first wave of payments. The first innovation sets was wallets, P2P, merchant and bill payment. I think the next big wave is kind of going to be leaning in more on the thinking about the next set of services that go beyond that. So you're starting to see people do business analytic, business services. You're starting to see a lot more work around retail and SME lending, and even the early beginnings, but still very, very early days of sort of wealth management related activities in the fintech space. So yeah, I mean, I think a long way away from payments being sort of at the end of its story. It's really still very much at the beginning.
Andre, you are also operating in North Africa as well. Do you see any differences and trends between the North African markets and, for example, more the sub-Saharan African markets?
Yeah, I think even within sub-Saharan Africa, I think there's, you have to adapt to the market. Generally speaking, if we look at North Africa, I think it's quite similar, less agent, but I think it's going, what Mayur was saying, towards more on the app side. But at the end of the day, I think the approach for fintechs, and as an investor, you have to look at those nuances in markets and where it's going and how it could scale in that sense. And that's why I think too that there's going to be one winner for Africa in the fintech, but several just because of these differences in the markets.
Tim, you are operating, a loan lending business. What do you see the trend there from that perspective? What is your mechanism?
So very much lots of agent interaction. I think it's been probably a decade where people have said they need to move customer ownership away from agents to banks and or lending businesses. None of that move has really happened. I think every lender is still heavily reliant on agents. Lots of agents work for multiple lenders. There's no such thing as exclusivity. Look, smartphones, yes, they're there, but there's no data that's available that's affordable. Smartphones don't have the storage to install meaningful apps. So net-net, the infrastructure to really move away from pure mobile-based USSD interaction and agents is just not yet there. For transactional purposes, we use USSD because you can transmit it over USSD rails. But then the second we have to get, do credit granting, do vetting, do anything more intelligent than a repayment or a drawdown, you need a smart interface. And if the person doesn't have a smart interface themselves, either by lack of data, lack of storage, or otherwise, they'll go to an agent. And so I think that's there to stay. I think in general, businesses have tried actively to move away from it have often actually ended up losing customers because they started pissing off the agents, and then the agents go like, well, if you don't want to work with us, we'll give all your business to someone else. But I think they've really driven inclusion in a way that, yes, it's probably not efficient, but at the same time, it is efficient in a sense that it's really created a wide penetration, wide coverage. Everyone knows where to go to. So it's lifted that digital payments. And I think one of the big things that has been fantastic in a lot of our markets for payments has been COVID, because it's really driven the move away from cash. And I think without COVID-19, we probably wouldn't have been as digital as we are today. And so in as much as a couple of people died, I think it's net been a great thing for Africa.
And with that, how do you see the future of cards in that market? Do you see, I'm speaking now specifically of Africa.
So South Africa is different. South Africa card is there, and I think mobile money has largely failed in South Africa because there was no need to go mobile. You could just use cards. I think rest of Africa, to build that merchant network, it's not worth it, right? Like, to really go put POS machines, it's very difficult. And I think mobile money has created a level of trust. But yet, if you'd have a mobile POS, right? You can have a POS on your iPhone or your smartphone. But if someone says to you, no, put your card down on a smartphone in a rural village, people won't trust it. They'll say, no, this guy is going to crack my card. He's going to. So people prefer that push payment where they push a payment into a mobile wallet. They know that they basically create a PIN on their device, move across money to know exactly what it is. So I think card, yes, for offshore and maybe for digital, but I think on the physical merchant side, it's just not worth it to build that network with the existing distribution mobile money has created.
Alvaro, what is your trend? You've got a more of a global view. What is your prediction maybe also for card penetration north of South Africa?
Yeah, look, I think you need to look at where, if at all, mobile money falls short to see where card penetration could potentially step in, right? And as was correctly mentioned here, it largely falls short on online transactions. It largely falls short on international payments or trading outside of certain regions within Africa. And so there is an opportunity to enable a card payment in that regard. And I think that can happen both at the consumer level, but it can also happen at the business level, right? There's a lot of businesses that deal in import and export and at some point need to make a payment offshore. And again, it's not necessarily a mobile money transaction that is gonna enable that payment. And then the second potential limitation is largely volume based, right? Mobile money transaction can only take you so far in terms of volume for a payment, and so there is an opportunity for larger payments to be done by card. That being said, that's still a sliver of the transaction volume in Africa today. So I think we're a long way off from, as was mentioned here, from cards substituting physical transactions. But as e-commerce grows, as international trade into the region grows, I think we'll see more and more penetration of that. And you can see great companies like e-banks, for example, now entering the market and trying to tackle that opportunity.
Thanks, Alvaro. Yeah.
I was just going to add on that as well. I think when we look at fintech and banking the unbanked and this movement, I think the vertical of fintech needs to be wider And this includes cards as well, right? Ability to do things that where mobile money falls short, where cash falls short. So we look at these opportunities as how is it adding to the vertical? How does it make it wider to service all these people in all these demands? And e-commerce is a really good example of that. And obviously the offshore as well. So I think there is a play, and I think you're spot on. Like servicing the merchants, I don't think that's going to be the one where it's going to be the most value add, but it's part of the fintech ecosystem in Africa.
With your, I mean, you are struggling as an investor, Andre, you are struggling both VC and private equity. The payment sector has been one of the most exciting sectors to be invested in over the course of the last 10 years.
Yeah.
It's the, you know, is it the gift that's going to keep on giving? Is it the, is there still growth in that sector available? What's your
it's a good
thesis on that?
question. Like the number of pitch decks we get in fintech is, I'm sure everybody that are investors in Africa gets a lot. I think the problem is still there, and it's still massive, and there's still hundreds of millions of people that could benefit from fintech. The big learning that we've got so far investing in the sector is that it's quite a race to the bottom to a certain extent. When we focus on payments, for example, and where we see the opportunity, and it ties back with the comment about the cards, for instance, is that we think the vertical, again, needs to be broader. And how can we better service those customers that ultimately there are revenue streams coming from other than just payments per se, right? And create that user stickiness. The number of early stage startups in fintech that we saw that went 0 to 1 so fast, but then the 1 to 100 is quasi impossible because there's no value add. It's always what's the best price for me, and then I'll switch app, right? The second thing is, I don't think I mentioned this already, but I don't think it's going to be a winner take all for Africa. I think there's going to be several players that could benefit and win. So we're still seeing new players coming in with new value proposition that's quite interesting. So we're bullish in fintech, and we continue to invest, but we really focus on how are you able to really service a client, not with just one product, because that's not where they're going to win. I was going to add one more thing too.
You're welcome.
Digital currency, I think, plays into that, right? We talk about card, MasterCard, just shy of 6.5 trillion in transaction last year. Stable coins was 6.8 trillion. And this is quite a good fit with the African problem when it comes to deflation of currencies and liquidity and so forth. And this is another area that we're looking at as well, right? How to better service these gaps. Yeah.
Also cross-border.
100%.
What are your views on the scalability? The market is there, but you know, is it going to take a new play in the market, or should we focus on the guys that are now in Series B, Series C, and pick the horse now?
Yeah, I mean, I think it goes to a little bit about where you think the market is. You know, are we oversaturated? Are we sort of overhyped or whatever? I mean, to your point, is the gift going to keep giving? Certainly not at 20x times revenue. You know, those valuations are gone. That music has stopped. You know, the historical trend was around 6 times, and that's plenty sufficient. So I think from a valuation side, that thing is bolted. From, you know, where are we in terms of where the market is and servicing the market? I mean, I think it's exactly as Andre said. You know, if you think about it, 3 out of 5 Africans today still are unbanked, and 90% of transactions still occur in cash. So to kind of then conclude that payments is overly saturated or we've already finished that party is like long way misses the mark. And actually, if you're in some of these markets where you now have quite a number of players, Nigeria and elsewhere, the people running those businesses don't say, hey, my main competition is what the person next door to me is doing. They still would say, no, the main competition is all of those customers that I still can't reach. So we're a long, long way from it. I mean, just to kind of put it in perspective, you know, African financial services revenue is about $150 billion or so. Fintech revenue as a whole, payments and all the other elements, we're talking less than 5. You know, so the story is just still beginning. I think we're sort of past the hype cycle, but the building is still going to keep happening.
Maybe just, you know, on that point as well, there's so much talk in the general VC, PE world, you know, about what's happening in Kenya, in South Africa, in Nigeria. But who's going to conquer the DRC? Who's really making the inroads in Ethiopia? Those are markets of scale. Do any of you have any views on that? And how difficult is it to transfer, geographically your IP, regulatory-wise, from in these jurisdictions? Alvaro, do you want to take a stab at that?
Sure. Yeah, I think the way that we look at it a lot is there first need to be, I would say, certain macro metrics that align with primarily technological investments, which is what we deal with, right? There needs to be a lot of investment in terms of infrastructure prior to any sort of software development or technology investment going in. And that, I believe, is why a lot of the markets have received a majority of the funding to this day, right? And the good thing and bad thing about the investing ecosystem is that it's largely driven by flywheels, right? So you have a case like Flutterwave, you have a case like Paystack, you have a case like Fori in Egypt, that gets you to that global stage. And of course, those are going to be the markets that are going to receive the most funding for the next 3 or 4 years, right? So there needs to be a layer of let's say, macro that kind of aligns with the technological investment, but there also needs to be someone to take that first plunge and for there to be a success case. I wouldn't be surprised nowadays if Tunisia becomes an incredibly hot investing asset just because there was an exit in the deep tech space there, right? So again, it's largely driven by flywheels, and this can be good and this can be bad. That also means most entrepreneurs will now flock to these markets because there is a lot of capital availability. But again, that doesn't mean that any market like the DRC or any other market within Africa doesn't have the potential to be there if the infrastructure is there.
Andre, you're flying out to Tunisia tonight, so what is your view?
Yeah, and so being an investor in these, let's say, frontier market could be very lonely. So we've explored markets that I think it was the first time these guys saw a VC, right? And it makes sense, right? You don't want to go alone. You want a few partners. You want to capitalize the company well. But Tunisia, I think you're spot on. There's a really good case study here. It's a small country, relatively speaking, but they understood that they have great assets, which is usually quite brain power and education, and they're quite involved in AI and deep tech. And they figured out a way to solve a problem that's not for their community, but really beyond how to export. And there's great value in that, right? As an investor, we look at how to go to new borders and new markets just to increase and have higher valuation and exits. And Tunisia did that with InstaDeep. It's not a fintech, but it's quite a good case study. So Rwanda is doing something quite similar, right? And now investors are paying attention, and we're starting to go there as a group. So it's quite interesting. But I would love, maybe as a founder, if DRC is on your roadmap.
Not a founder, but certainly on the operating side. I mean, DRC, it's hard to ignore, right? It's such an enormous market, so underserved. I think a lot of companies who've recently gone in, part of the attraction has been, a lot of that is on US dollar-based transactions. Specifically around some of the trading hubs around Lubumbashi and elsewhere. I mean, personally at M-KOPA, going to DRC is not on our roadmap. The next market for us is launching in South Africa, which we will do. And even that, interestingly, feels like a stretch because of how different South Africa is relative to so many of the other markets in sub-Saharan Africa. But Jack and Ebury works across all of these markets as well.
Yeah, it's interesting. I mean, DRC, for example, like you said, it's all dollar flows. There's two separate conversations here on crypto and blockchain later on. But for me, I think, and you touched on it earlier on, for some of these regions, you look at things like stable coins and the impact that they would potentially have on driving capital deployment. Now, capital deployment throughout Africa, it's very easy to deploy. It's very hard to get it back, as we all know. And ultimately now what we're seeing from the side that I see in terms of technological development around things like stable coins, around localized liquidity, is opening those spaces for a freer flow of capital. So yeah, look, let's see how that develops, certainly in places like DRC, and let's maybe, I know 12, 24, 36 months down the line, let's see, certainly from my standpoint, I think from a stablecoin point of view, what that would potentially do in terms of free flow of funds.
Look, the panel is called the disruption in this fintech sector. Ebury is a disruptor as a competitor, as well as a partner to the banks. What are the trends that you are seeing in Ebury? You're also working across West, East, Southern Africa, and you've got a view on the frontier markets globally. What are the treasury trends that you are seeing and that are disrupting the provision of the liquidity for all these fintechs operating in the market?
Yeah, that's a good question. I mean, we're having this conversation 3 years ago. I might as well just say one word, or 2 words, US dollar, and then leave the room, right? I think that the reality is this, from what we see from a development side of things, a lot of in-ground technological developments around localized liquidity. We do a lot of work we were having this conversation, funny enough, just before we started, around Nigeria as a very topical user case at the moment. We're now seeing localized banking infrastructure allowing larger scale liquidity in things like Naira. Now, for us, what that means and what I'm starting to see more of now is more of an appetite to invest into Africa, knowing full well that there's more certainty about the hedging and the returns that come back. This whole premise of trapped cash. We hear that day in, day out at Ebury. And the reality is this, 5 years, 10 years down the line of investment previously, you now have concerns. I think what you're seeing now is a much freer market. And ultimately now that's going to lead, I think, to further flows into, not just Nigeria, not just Kenya. Lots of people have been asking me this couple of days about Ethiopia, for example, Egypt. These at the moment have been very
Angola,
hard.
DRC.
Angola, yeah. So, Angola is a very interesting one.
Zimbabwe.
Yeah, all of these things. But what I see from a liquidity perspective now is I'm seeing rapid developments. Again, if we had this conversation a year ago and you were asking me about, repatriating Naira back into, European economies, there was no chance. Now this is becoming something that's becoming more prevalent, and I think that's going to continue throughout the region.
Thank you. We're going to come back to that shortly. Mayur, I want to ask you, how do you see the impact of interest rates? I think in the previous panel it was also said, decisions are made on interest rates on the other side of the Atlantic, but it's got a real impact on SMEs in Africa, fintechs. How do you see this play out in the market at the moment?
So I think in the low interest rate environment, there was a big drive for credit. Credit was more affordable, maybe not on Western standards, but more affordable, which by itself drove digital adoption, because to get credit, people need to have digital accounts, you need to be able to assess their data. Right now, with interest rates going up, the credit people took, specifically in markets like South Africa that are probably over-indebted, but at least heavily indebted, has really impacted people's affordability. Suddenly, it's harder for them to make ends meet, and it's moved the risk appetite down, which means that where there was a push previously to get people to move from offline to online to give them credit, that's no longer happening. And when you deal with the loan shark on the corner of the street, they don't care about financial inclusion. They actually want to be paid back in cash. So the increase in interest rates, I think, will actually have an inverse impact on digital penetration, people going back to alternative sources of credit that are probably not the preferred form. Long term, credit requires data, and I think it ties back a little bit to the question of markets like DRC. It's hard to go to the DRC because there's no data. Now, yes, you could go with mobile money technology, but the biggest problem in the mobile money is it's about convertibility. Money is only worth what you can do with it. And I think in a lot of these markets, that mobile money hasn't gone through the journey that it's gone through in Kenya, where effectively everyone started using it. It's now convertible. So you start a business in Kenya, you can build the most exciting tech on top of mobile money. You start a business in DRC, you have to first build the infrastructure. Yes, if you win at building the infrastructure, that's a great play, but that investment of winning and building the infrastructure is very material on signing up all the merchants. And I think, like Zimbabwe, for example, had the benefit of even local currency cash running out. So there was no cash. People had no other choice but to transact digitally, so they moved to digital. they ran out of physical US dollars, they ran out of everything for a period of time. So people ended up going digital. But if you don't have that macro push, that incident, that's, probably for people on the ground, it's not the most pleasant experience. I think it's very hard to go into a digital environment. And I think it will take time now with interest rates where they are to have that same push on penetration.
Although South Africa is a much deeper market and you're about to enter the South African market, what would your view be if I say to you that South Africa is just running ahead of the rest of the pack with regards to unsecured debt? Capitec has grown 10,000%. They have formalized the unsecured lending market, and now the whole market is constrained. Is this not just going to happen in all the other markets with that model?
Yeah, I mean, it's sort of interesting. I mean, you think about South Africa now, the kind of easy answer is South Africa is a super formalized economy, super heavily banked, et cetera, et cetera. But actually, I mean, South Africa increasingly looks like a two-state economy when you really get into the guts of it. And interestingly, part of the big changes from COVID has meant South Africa is starting to look more and more like some of the other sub-Saharan African markets, because the informal economy is actually what is now really growing massively. And part of the big change in South Africa, even on the payment side, has been the growth of agent-based payment services, and people being able to kind of cash in and cash out at retailers and a whole bunch. That is really changing, and meaning that the informal economy is now kind of much more visible, because you're now starting to get all these data points from that side of things. So I think less likely that the rest of Africa is going to look more like South Africa, perhaps more likely that South Africa is going to look more like the rest of Sub-Saharan Africa as you think about some of this evolution. You're still going to have the part of South Africa which is such a highly advanced economy, which will remain as is, but I think the growth is going to come from that informal side.
Yeah, it's very interesting if you match, what has happened with the South African investment team sitting in another room. I don't think they are aware of the strategic opportunity that players in other markets are seeing. I mean, Ebury has also just acquired a business in South Africa going into the South African market. So it's a very interesting, I was almost saying, a mean reversion in the South African market. And there are players coming out of Africa with experience operating in that informal market within the, like you said, within that space. I think what we haven't discussed is really the cross-border FX operating cross-border. What are the developments that you see there, Jack, from a cross-border perspective for corporates, just operating between, a shilling and ZAR, or moving between North and Sub-Saharan Africa?
Yeah. Again, I should probably just say US dollar every time. But
can we not get rid of the US dollar piece?
We can try.
Is that what blockchain is going to do for us?
No, look, I think, again, the reality is this, that it comes back to liquidity once more. But witnessing the movement sort of into territory, right? So within Africa itself, not necessarily, a lot of our time is focused on European and US capital being deployed into the region. But if we look into region now at the moment, there's a lot more flows. And actually, some of the partners that we utilize, some of the people that we work with at the moment, are creating some incredibly interesting markets that didn't exist previously. We were talking earlier on, I was talking to someone else, but we are starting to see freer flow of funds, Uganda into Rwanda, and for me, again, that is just something that didn't exist. So when we talk about payments, we talk about innovation, and we talk about development, that genuinely is something that's completely brand new. And for me, it's good. It's good for the region, right? It replaces less reliance on what we had to do previously. And for me, it gives a lot of in-country autonomy to those corporates. And theoretically, without stripping out things like, stable coins, it should offer a much more efficient and freer flow of funds.
And just sideline the US dollar in the whole equation.
And yeah. I mean, look, the dollar is king. The dollar will remain to be king long after we all sit here. But its role is becoming less significant in the movement of capital within those regions.
Can you, maybe it's more pertinent also to M-KOPA. Everybody else here has got that. But what do you see the influences of, AI and machine learning is in basically client engagement and taking the fintech sector forward with regards to the client experience? And
Yeah, I mean, it's pretty exciting, really. I mean, we're so just at the beginning of this massive change. I mean, I think if you think about what AI has done for customer engagement, consumer experience, I think the first iteration that all of us think about this is, AI-based consumer chatbot engagement. And a lot of that early stuff, which has been around for several years now, felt pretty clunky. But I think if you actually dig into the details now, from what a lot of financial service businesses are doing, over 60% of customers who interact with these AI chatbots have no clue that they're interacting with an AI chatbot now. I mean, that's how seamless this thing has gotten. I mean, that's 6 out of 10 of us in this room. We like to think it's not us, but it really is. So I think that's sort of the first wave of this. The second wave, which is starting to see more and more, is really good consumer segmentation and personalization. That's part of the big power that is starting to come through a lot of those services. And the interesting thing is our AI is now fairly embedded in a lot of the off-the-shelf services. But I think the next big thing, and even some of the stuff that we're doing at M-KOPA, is being able to use machine-based learning and AI to start powering up your predictive capabilities. And this is really around customer engagement and churn, when you can start to look at frequency and risk and repeat behavior to start saying, how are those cohorts of customers going to evolve, and being able to intercept that before it happens.
cross-selling as well.
Yeah. So I think, still right at the beginning of what this looks like.
If I could add something on that from an investor's perspective, I think what's happening with AI in Africa is extremely applicable and very important to look at. You mentioned chatbots. I think it's incredible that you could code chatbots in so many different languages, right? And super cost effective, and yet the customer feel like, okay, I'm chatting with somebody that's one of mine, right? So that's the first point, and that's just the surface chatbots. The second thing you mentioned, I think it's extremely important, is that when we look to invest, and we're quite focused on deep tech, ML, and all that stuff, is that you have to differentiate between outsourcing or an add-on for AI, such as a chatbot, or are you building something that's defensible based on the data that you own that nobody else has, which is your ML, right? So it's quite interesting how you could leverage AI, customer-facing, you could outsource this, it's cheap, the value is great, but not defensible, versus building your own thing that nobody else could do, and you reach scalability. So I find it important to know.
I mean, it totally changes the investment thinking internally.
100%.
Because on the one hand, there are a whole bunch of your operations that suddenly change dramatically. Workflows shift, things become cheaper. I mean, that's the big story. These are sort of nuclear type capabilities that are now fairly accessible to fintech operations. And it should ideally start to free up capital to do that more competitive capability work. That's exactly as Andre said.
And you can move from country to country with the language changes, which is quite difficult to navigate. I'm going to, before the bell rings, I'm actually going to start, because there's a number of very exciting things. I've got a couple of questions still up my sleeve, but I think I'll maybe just give an opportunity now for anybody from the floor, if there's any questions from anybody from the floor, which we can cover. There's maybe also who you want to address to, if you want to.
Okay, so my question, maybe I don't understand how money works, and maybe I might need to research that, but my question is, why do we have to go to the US dollar? Why do we have to transfer from Kenyan shillings to the US dollar and then to the Nigerian naira? Why can't we just transfer directly to the naira? That's my question.
Who wants to take that question?
Okay, so I'll give it's a very good question, right? It's very topical at the moment. I'm trying to think of the quickest way to explain this. So you have the two major currency pairs in the world, euro dollar, sterling dollar. Okay? Most cross currencies, or how markets are created, is that they have to cross through a reference point to generate a rate on the other side, right? So traditionally, obviously, one currency is flowing through the dollar, and what you don't see on the back end is it's going back out the other side. In a nutshell, that is why. in the same way as, why did I only ever have to pay with cash, right? It's because the development wasn't there and it wasn't required. Ultimately now, what you're seeing more of a flow, it's about liquidity, okay? And not to go off on too much of a tangent, but what you're starting, the interesting developments here are what we would call market matching. So it's intra-country matching of buyers and sellers of localized currencies within what we would call marketplaces or behind the scenes marketplaces that allow for that flow of liquidity, and it removes the requirement for the US dollar.
I may also just add to it, and it's an important general point, is that almost all the fintechs that are operating within Africa are funded from outside of Africa, or a very large percentage. So until the insurance industry, the pension fund industry does not become LPs, investors, have got an allocation for the fintech or the venture capital industry in general to develop business at the lowest end, you're going to have external money coming out of the system. So at one stage, money has to come into the country from somewhere, and the money needs to go back. And wherever it's coming from, that's what we call in Africa hard currency. It's either going to be US dollar or it's going to be euro, and those investors will want to be repaid in that currency. And that is the flows that need to be both managed within, the return that needs to be managed in country, and the flow that needs to be managed going out, by Ebury or the banks. And do we have another question at the back?
Thank you. As I think, as rightly said, the penetration of the technology was made easier in Africa because of the very low penetration of the banking system itself. So now when the technology moves towards areas where the banking sector is more formally working, it looks like there is a tension between the bankers and those who own, for example, the telecommunication companies. Because in some countries, the linkage is not there. So the banks see that most of their markets being taken over by those technology providers who are providing the mobile banking. So have you observed those kinds of trends, and how do you think that could be resolved?
I think, Alvaro, do you want to comment on that? It's probably the same everywhere globally.
Yeah, I mean, I think you correctly state that there's telcos are acting as banks in a lot of the markets that we're looking at, and so of course there's going to be a tension between the banking sector, the fintech sector, and the telco sector. But more than that, we've seen collaboration across these segments, right? As it is different in Africa relative to other markets. Usually it was the bank that took both the payment and the lending stack, which are like the two broad big parts of the financial services industry, excluding kind of wealth management, right? But whereas in Africa, that's divided across two different players. The telcos largely took the payment stack, while the banks took more of the lending stack. So I think what we're seeing is, and in terms of technology, is those companies that are focused on servicing more of the payment stack are working a lot closer with the telco industry, whereas those that are working with banks are largely servicing the lending industry.
And the common point with what he just said is that then you have fintech in the middle, right? It's always the telco wants to innovate. They look at fintech to embrace their ecosystem. Corporates want to innovate. They look at fintech to innovate. Diamond Trust Bank out of East Africa just did a big partnership. I'm forgetting which South African fintech. Safaricom, again from East Africa, are looking to be part of this ecosystem. As an investor, I love it because I'm investing in fintech. Maybe there's an exit too, right? So I think the word here is collaboration, and with fintech as the conduit for that.
I mean, as an example, Tim, would you say you're competing with the banks?
Both. We service, I think, different segments. There's segments the bank's currently not servicing. The bank to us is a financier. So it's all different pieces coming together. I think in general, I think Andrea or Alvaro said it earlier. I think payments is a standalone offering, which is historically the first core piece that M&O is competing on, is a race to the bottom, and it's a race to zero. If you look at Europe, direct bank transfers are free for customers. So you have to offer value-added services, and the payments, it's only one piece, and I think banks will have very distinctly different value-added services from M&Os. There's stuff you can do with an M&O wallet, there's other stuff you can't, and people just need to collaborate. But there has been historically a trust gap and a lack of collaboration in the ecosystem, and I think that lack of collaboration has been problematic. But I think now that payment prices are under pressure across the continent, I would say, you see that people start to understand they need to offer the value-added service. Actually, banks should not try to win back the mobile money payment infrastructure in Kenya. They should integrate with it, work with it, and figure out how to get the interoperability right between the two ecosystems.
Yeah, thank you. I'm going to be very exact on our time to end here. Thank you very much to the panel. I think it's an ecosystem that is very dynamic, that's, as we rightfully said, with regards to the, between the banks, the fintechs, telcos, the market will continue to evolve. And I thank you for you guys for your insights, and thank you very much.
Thank you.
Thanks, Kobus.